So if you want to make money trading, and I'm not talking about winning a trade here, losing a trade there, I'm talking about being consistently profitable. If you want to do that, you need to learn risk management. So in this video, you will learn risk management for trading stocks, Forex and crypto. We'll take a look at the most important concepts, the tools you need to use, and I will even show you guys a special tool we have here in our YouTube community that you can use to calculate important things like expected value that we will talk about, but also things like position sizes, risk reward, and more. But alright, so let's begin here by answering the very important question: what is risk management? Well, risk management is basically the practice of protecting your trading capital. This is basically just a fancy term for saying protecting your money. And we basically do that by controlling our losses, controlling our potential losses we have on each trade. And this helps us survive bad trades and, stay in the game for the good trades. I would say that a lack of risk management is the by far most common beginner mistake. So I already want you guys to have this in mind. If you trade without risk management, this is basically like gambling. This is basically like going to the casino, as you can see right here, like betting in the casino. So you need to learn risk management, so make sure to really pay attention throughout this whole video. But now, what are the most important risk management building blocks? Well, the first one you might have heard about, and that is stop loss orders. A stop loss is basically a predefined exit or a predefined level on the chart that limits your loss on a trade if the market goes against you. So let's say that you buy at 100 right here and you set a stop loss at 90. If the price goes down to 90, you will automatically sell. Then we have something called a risk to reward ratio, and this is basically a ratio comparing your potential loss with potential gain. So for example, a 1 to 3 risk to reward means that you are risking $1 for every $3 you are making. And don't worry, we will talk more about risk to reward soon. Another very important thing here is position sizing, and we will take a look at this calculator later on in the video, which you can use to actually calculate position size. And for now, this calculator is available for channel members. All MindMath Gold and MindMath Diamond members have access to this calculator, and we will take a closer look at this calculator later on. But it can be very useful for calculating the position sizing. And last but not least here, another very important risk management concept is the 1 to 2% rule. And this is that you never want to risk more than 1 to 2% of your trading account. And this is also, as you can see right here, this is a part of the position calculator as well. But now let's move on to some very common risk management beginner mistake. And the first mistake here is basically the belief that trading is a very quick path to riches, and this leads to risking too much, and this is often the path to losing a lot. I think we have a quote, something along the lines that trying to get rich quick is the quickest way to get poor quick. It's not exactly like that. I misremember the exact quote, but I think you get the point here. Another very common beginner mistake here is not using stop losses, or basically moving the stop losses away when you trade. You need to respect your stop loss. Another super important mistake here is over leveraging with borrowed money, or in other words, using too much leverage. And when it comes to leverage, we don't really have time to dive deep in this video, but I actually do have a full video where I go over everything you need to know about leverage, and I highly recommend to check that video out after this video. Last but not least, this is another very common mistake, is the what I call it will come back mentality. And that is basically that you hold on to a losing position for way too long. Perhaps you move down your stop loss, the price continues to go down, you move down your stop loss even more, and you think, you know, the price will eventually come back. This is a very dangerous mentality. But alright, so now let's actually take a closer look at the risk to reward ratio. This is one of the most important concepts to understand when it comes to risk management. And the risk to reward ratio basically compares what you could lose to what you could gain on a trade. So it basically helps you determine if a trade is worth taking or not. And here, many trading strategies use a risk to reward ratio where the reward is at least 2 to 3 times the risk. So it's very common to hear that we have a 2 to 1 risk to reward or a 3 to 1 risk to reward, meaning that we win at least 2 to 3 times as much as we lose. So here, if we scroll down, we have some examples of risk to reward ratios. But I think it's easier to just use a calculator. And by the way, if you want access to this calculator and also the expected value calculator and more stuff in our YouTube community, please don't hesitate to become a channel member today. We would love to have you in the community, and you will also get access to tools like this one. But let's go to the risk to reward ratio here and take a look at some examples of risk to reward. So let's make a very simple example. Let's say that we enter a stock or cryptocurrency at $100. We set our stop loss at, let's say, $90, and we have our take profit at, let's say, $110. Here with the calculator, you can also choose your win rate. So let's say you have backtested and have a win rate of 60%, and then we can calculate the risk to reward right here. So first of all, you can see here that here, because we risk $10 and we can win $10, we have a 1-to-1 risk to reward. But very importantly here, because we have a 60% win rate, you can actually see that we have a positive expected value. And this is something we will talk about later on. You also get this notification here that the risk to reward ratio is low, and it's recommended a minimum of 1 to 2 risk to reward. So let's actually choose a 1 to 2 risk to reward, which will be if we have a take profit at 120, right? Because if we have a take profit at 110.20, let's calculate. As you can see, our risk to reward is now 1 to 2, and once again we have a very, very nice positive expected value. So yeah, now you have a basic understanding of risk to reward. Now I want to turn the attention to something very important. And this is basically calculating the break-even win rate. So to determine the minimum win rate we need to break even, we can use this formula right here. It's not super important to learn the formula, but I hope this can make a good sort of intuition. So if we have, first of all, if we have a 1-to-1 risk to reward ratio, so we risk one, for example, risk 100, and we can win 100. Then it's pretty clear that our break-even win rate is 50%. So if we win 100, lose 100, win 100, lose 100, we will, go even. But here, if we have a 1 to 2 risk to reward, meaning that we win 200 and lose 100, now we only need to win 33% of the time. So if we win more than 33% of the time, we will be consistently profitable. And this goes on and on. With a 1 to 3 risk to reward, we only need to win 25% to break even, and so on and so on. So I hope this gives you guys a sort of good definition about the break-even win rate. But alright, so now let's actually switch the attention to position sizing. This right here is very important because this determines how much you should trade, how much capital you should use. As you can see, position sizing determines basically the number of shares or how many cryptocurrencies and so on that you should trade in order or so that potential losses stay within good limits. And a good rule for this is to use the 100% rule, or in other words, you should not risk more than 1% of your account in a single trade. This is a pretty conservative rule, but it's a good rule, and if you follow that rule, you will not, blow your account, which is a very common and devastating mistake that beginners make. And here, if you use our Mind Math Money community calculator, you can just go to position sizes here, and the standard, the original value here for the risk per trade is 1%. But some traders, as you can see here, the conservative value is 1%. Some traders use 2% or even 3% risk per trade here. But to make this clear, let's say that we use 1% risk per trade. And as for our account size, let's say we have an account size of $10,000. And to make this a super simple example, let's say that we enter at $100 and we have a stop loss at $99. So the stop loss is $1 down. You can also choose your market. Let's just, for example, say we choose crypto right here and make our calculation. Now, just like that, you will see first of all, how much you risk. We risk $100 because that's 1% of $10,000. You also get the risk per unit, and that is $1 because of our entry price and stop loss. Our position size is a total of 100 coins, and our position value here is actually 10,000. And here you get an automatic warning that this position uses 100% of our account, and that might not be, optimal. But right, so now I do want to talk about what, at least in my opinion, is the most important concept in risk management, and maybe the most important concept in trading in general, and that is expected value. So if you haven't heard about expected value, make sure to really pay attention. In simple terms, the expected value is the average amount we can expect to win or lose per trade if we take many trades. So this is basically a measurement that combines our win rate with average win and loss size. So when it comes to trading, just as a simple example, let's say that you have, let's say that we have a 60% win rate. This means that we also have 40% to lose. And if you have a trading opportunity with 60% win rates, and let's say that you risk 100 and you can win 100, then this is a trade you should always take, because if you take many of these trades, you will make money. But this doesn't mean that we can't be unlucky and maybe lose, 2 times in a row or even 3 times in a row. A 40% chance can happen 3 times in a row, 4 times if we are unlucky. And that is why such an important part of expected value is that we actually take many trades. So as you can see, right here is the formula for expected value. The formula is that you take the win rate times, how much you win, minus the loss rate times how much you lose. So here is a simple example, but as always, I do think it's so much easier to just use our Mind Math Money calculator. So now we are back here in our Mind Math Money risk management calculator. You simply want to go here to expected value. And as a very simple example, let's say, once again, let's take the 60% win rate example. You can also use this slider here to choose whatever win rate you want, but let's choose 60% here, and let's make this super simple and say that we risk 1,000 per trade and we can win 1,000 per trade. Now let's calculate the expected value. Just like that, you can see that our expected value, so this is what we expect to win if we take a large amount of trades, is $200. You also get some nice information here. You get the risk to reward ratio, you get the break-even rate, you also get the expected profit over 100 trades. So if we take 100 trades with this strategy, we expect to win $20,000. And by the way, guys, if there are any terms you don't understand with this risk management calculator, I have all the terms explained in very simple terms right here on the page. And I also have a members only video where I go into more detail on this risk management calculator. But alright, so now I want to talk about a super important concept, and this is to manage drawdowns. And what is a drawdown? Well, a drawdown is basically the decline from the peak in your account to the lowest point. And a very important concept here is that larger percent losses require even larger gains to recover. So for example, if you have lost 10% from the peak, we actually need 11% to recover. If we have lost 20% from the peak, we need 25% to recover. And you can see that this gets worse and worse. If we have lost 50% from the peak, we need 100% to recover. And if we have lost 90%, we need 900% to recover. So this, I hope that this table just show you guys how important risk management is. And here, and this is very crucial, this is why avoiding deep drawdowns is so important. The bigger the hole, the harder it is to climb out. That is so true. And here, last but not least, these are some memorable things to have in mind after this video. First of all, you want to take care of your losses, and the profits will take care of themselves. This is one of these classic quotes which do have, it does have a lot of truth to it. Another thing is you should focus on preserving capital rather than trying to make quick profits. Remember, trying to get rich quick is often a quick path to getting poor. Also here, make sure to be more defensive during drawdowns, because as you recently saw, the bigger the hole, the harder it is to climb out. The larger the drawdown, the harder it is to recover. And also, another key thing is that you can actually adapt your risk management to market volatility. So if we have more volatility, you may want to reduce, for example, your position size or risk to reward ratios. And also, last but not least, remember, you can't trade at all if you have no capital left. But alright, so now when you have a good understanding of risk management, you're ready to start learning about how to trade. And you're in luck, because right here on YouTube, I have lots of full trading courses, and you can access them all by clicking or tapping on this playlist right here.